Welcome, and thank you for tuning in to ESG Talks, a KBRA podcast focusing on environmental, social, and governance, ESG. This podcast series highlights various ESG hot topics and includes commentary from prominent voices within the ESG community. In this episode of ESG Talks, I interview KBRA's President and CEO, Emilie Nadler, and Pat Welch, KBRA's Chief ESG and Ratings Policy Officer. With recent market developments and a move by some rating agencies away from ESG scoring systems, Jim and Pat discuss KBRA's view on ESG scores and the evolution of KBRA's ESG philosophy. As a credit rating agency, KBRA remains steadfastly focused on analyzing the financial materiality of ESG factors and their relevance to credit today and in the future. KBRA's position has long been that the process of merging ESG scoring into credit ratings muddles the purity of credit risk analysis by introducing ESG metrics that may have little to no financial materiality. Hi, everyone. This is Emilie Nadler from KBRA's ESG team. Thank you to Jim and Pat for joining. Pat, I want to start by asking you, as a founding member of KBRA's ESG team, about the evolution of KBRA's ESG approach. How does KBRA think about ESG issues?
Hi, Emily, and thanks for the question. First, I want to start with the fact that KBRA has done extensive investor outreach, and our approach comes directly from this outreach. Early on, our research indicated that ESG ratings are imbued with some serious problems, which we can discuss. But as a result, we made the deliberate decision not to develop an ESG scoring product. We knew early on that this would not serve the market. As a credit rating agency, we believe our value to the market is analyzing how ESG issues affect or have the potential to affect the risk of default, which is what a credit rating measures. We realize that very few ESG issues have specific financial quantifiable outcomes. Rather, for any issuer of debt, there are a range of potential risks that must be considered. We call this ESG management, and our approach, we refer to it as the ESG management approach. It's a nuanced analysis that covers lots of different considerations, and we use that approach as opposed to a quantitative scored taxonomy. Now, having said that, while there are a range of issues that must be considered for each issuer, KBRA has identified three, what we refer to as anchor issues. And these are ESG issues that we think intersect with credit risk analysis that are common to most issuers of debt. And that is climate change, stakeholder preference risk, and cybersecurity.
Got it. That's helpful. And so, Jim, as Pat mentioned, KBRA decided early on not to provide separate ESG scores. I'd like to get your perspective on some of the investor and regulatory feedback that we've gotten on these separate ESG scores and their utility. What are some of the challenges with these products?
So thanks, Emily. I think the first and probably the biggest is coming out of the great financial crisis, the opacity of many of the models that supported credit ratings became a huge issue, and the regulators in almost every jurisdiction sought to make credit ratings more transparent, and investors have come to rely on that transparency when they're making these decisions. And so all of a sudden now they're faced with these standalone ESG scores that are incredibly opaque. And in addition to that, mix too many issues into a single rating. I think what we kept hearing from investors is that they were confused by the rating. The way it manifests itself was you would find investors often showing us one particular company that had the highest score from one issuer and the lowest score from another issuer of ESG rating. And so there was a lot of confusion in the market. Regulators that we talked to globally had a different view. Their take on it was, look, if investors are making decisions about where to invest and the information is not clear and not transparent, then we have a role to play. And so I think that's why you're seeing regulators around the world start to look into these different standalone scores. You know, in addition to that, there were some smaller issues, and they came down to value judgments. And there's nothing wrong with value-based judgments. It's just, again, the transparency. You need to know where weightings are, where the value judgments are in any issue that you're looking at to determine whether you agree or disagree with it. And again, because of the opacity of these ratings, it wasn't clear whether people were leaning more toward giving it more credibility with respect to board diversity or with respect to their impact on climate. So what it led to was, again, just a lot of confusion around the ratings. Last, and I think the most important, was that it had a bias toward larger entities. And so it's as if the more information you had available, the better your score was going to be. And that's not necessarily true. We've found that in several of the different areas that we do credit ratings, where we have found that mid-sized entities can have sometimes better credit ratings than larger entities. And so this size bias became a big issue with respect to the scores. And I think it's one of the reasons regulators are starting to look at them as well.
Yeah, that was definitely one of the key points in some of ESMA's consultation papers, just the worry that larger companies have so much more resources to spend on ESG, right? So obviously they're going to have staff dedicated to filling out these disclosure questionnaires and things like that. So the scores might be more biased towards larger entities that had those resources.
Well, and that's a really interesting point that you make, because we have worked very hard in the financial institution space, where we actually rate the largest number of mid-sized financial institutions. And what we found was they were being disproportionately harmed by the fact that investors were concerned about negative ESG scores that they were getting from some of these standalone rating entities. And what we found was that it was simply a matter of they didn't have the resources to provide the information to these companies, and they didn't have the capacity, they didn't have people to help. And so we ended up working with our rated banks to help them disclose more in the rating analysis. And so when we started doing that, it actually helped the banks with this issue that they were not able to share the required information to get the benefit of the things that they were doing with respect to whether it was climate change, whether it was diversity, stakeholder impact, or whether it was cybersecurity. They didn't have a means of disclosing it. And so we actually have been very helpful in doing that. But again, it's focused on transparency. It's getting the information out to investors.
Definitely. So Jim has provided kind of an overview of the challenges with separate ESG scores. But Pat, why is it a problem to provide ESG scores alongside credit ratings, as some of our competitors have been doing? How does this muddle the purity of credit risk analysis?
Yeah, that's a great question. And Jim, you gave a comprehensive take on the flaws generally in ESG ratings. We see an additional problem in the credit rating agency arena. And that is the problem that this idea of bringing ESG scores into a credit rating analysis. The main problem with this is that these are different scoring concepts and they're aiming for different outcomes. Merging one inside of the other creates a lot of confusion. So Jim just talked about the confusion that exists within an ESG rating. Well, this goes even further to confuse credit rating analysis by incorporating those ESG scores. You can think of a credit rating analysis really as a scoring system for the risk of default. But ESG scores, on the other hand, are scoring many different things. Many are not material to evaluating the risk of default. So by merging them together, you raise serious confusion and maybe even trustworthiness about your credit rating. KBRA, I think, we believe as a regulated credit rating agency, our credit rating analysis should focus on the issues that have relevance to creditworthiness, or i.e. risk of default. And they should be rigorous, transparent, and trustworthy in regards to risk of default.
Great. Well, I think that's really helpful for understanding the issues with ESG scores. And it will be interesting to watch the evolution of ESG ratings regulation and how that really changes the space. But Jim, I also want to just get your thoughts on how do you see KBRA's ESG approach aligning with the firm's founding mission?
Our view on how ESG should be incorporated into the credit rating process aligns directly with our mission. After the great financial crisis, we were founded on the idea that investors needed more and better information, and that information had to be transparent. And it's exactly the way that we think about the different pillars of ESG, whether it is stakeholder risk, whether it is climate change or cybersecurity. We believe that investors need the best information, the best analysis, and it needs to be completely transparent. So you'll find that our views on ESG and how to incorporate ESG in credit rating and financial analysis, and particularly around disclosure of ESG factors, fits really nicely with our founding mission and is, I think, the reason that investors have become such fans of KBRA. It's because of this idea that we provide the best, most thorough information and analysis, and it's completely transparent. It's not a mystery how we arrive at our conclusions, whether it's a credit rating or whether it's how we evaluate the impact of an ESG factor.
Jim, I want to stay with you and I want to get your thoughts on the ESG backlash that we've been seeing in the US and it's now starting to trickle into Europe as well. Why do you think that this backlash is happening and where do you think ESG will go from here?
Well, it's interesting. I think the backlash is happening because it has become a cultural issue, not just in the US, but it's become an issue in Europe. And this idea of if you belong to one political party, you've got to think one way about everything that political party thinks about. And so we're seeing that just broadly happen around all kinds of things. But I think with respect to ESG, I think one of the biggest issues is that much of the lack of transparency around this issue has created a vacuum or a void. And what has filled that void is a lot of misinformation. And you even heard Larry Fink a few weeks ago come out and say he's not going to use the letters ESG anymore because they've become such a problem globally. I think that we remain focused on key aspects of ESG, on transparency, and also that we're providing investors with all the information they need to make an investment decision. As long as we do that, I think we'll avoid a lot of this nonsense that's going on.
I think that's a great point, and it really gets back to the challenges that you listed out with ESG scores. And I think one of the biggest challenges is because of the lack of transparency, you really don't know whether they're looking at ESG from an impact perspective or from a financial materiality perspective. It gets mixed up in the scoring. And so you don't really know how they're measuring it. So that's a really key point. And I think just for KBRA as a credit rating agency, we're obviously focused on the credit side of things and how ESG impacts that.
Right. And also I'd add one other thing, and that is that none of this is black and white. I mean, it's all a continuum. And what you'll hear from investors a lot of times is that they're interested in investing in companies that have a heavy carbon footprint, for instance, but that are moving to reduce their carbon footprint. They need to understand what that means from a financial standpoint and what that might do to their rating. And so both need to be completely transparent. And most important, they need to be understood separately.
Great. That's very helpful. Lastly, Pat, I just want to ask you, as ESG evolves, how do you see KBRA's role in the ESG space moving forward?
Yeah, I'd like to expand a little more on what Jim just said, to make sure everybody's clear. KBRA understands that the two different perspectives of ESG, the financial materiality sort of on a company, and then, the impact a company has on the world, both of those perspectives are very important in the marketplace. we are distinguishing ourselves by making sure that we don't undermine or create confusion in our credit rating opinions, which relate to the financial materiality aspects of ESG. But both sides of this are very important. I think when you analyze ESG factors, it really requires nuanced analysis. Many people might think credit rating analysis is a simple exercise of looking at an input and then predicting an output. And the reality is much different from that. When a management team is trying to understand the wide breadth of risk of ESG factors that a company may face, they're thinking about trade-offs that they have to make. They're thinking about interconnectedness of decisions they make. And so all of this means that as a credit rating agency, we can deliver value in helping people to understand that nuanced analysis. And the way we want to do that going forward is to make sure, again, that our analysis is really focused on risk of default, but that we're also trying to provide the marketplace with information that helps them better understand the nuanced analysis of managing this risk. So we really see ourselves as a provider of credit-connected ESG information. And we're going to be working and have been working to increase the type of information that investors find useful and important for making best informed investment decisions. We know that ESG factors are evolving quickly, and we also know that some of those factors are long-term. And so as a credit rating agency, the fact that we're focused on financial materiality doesn't mean that our job is easy, meaning that we're not focused on all the impact stuff. It doesn't mean that our job is easy. Risk is evolving. You can look at the climate change to see that in the headlines every day. Working very hard on understanding these evolving risks. And in one place in particular, I can give an example of that. We've started working with a carbon emissions data provider to really have a much better understanding of how that risk is evolving. And some of that requires actually models to predict emissions that aren't clearly being disclosed. Maybe they're not being disclosed because they're not well understood, or there are other reasons companies have challenges in their carbon emissions disclosures. So we're working with a data provider to better understand that, because we understand that carbon emissions are a global cost. But what the world is trying to figure out right now is how do you take that global cost and actually allocate it company by company or debt issuer by debt issuer. That is a huge challenge for the world. And it's one that we understand is going to be necessary to solve the global warming crisis. So we do believe that is a developing risk, a developing cost. And so we're trying to get very smart, have great data, and understand that evolving risk that is carbon emissions.
Great. Well, I think that's all of my questions. Thank you both so much for coming on. I think this is a helpful overview for our listeners about the challenges that we've seen with ESG scores and KBRA's ESG philosophy. So appreciate both of you being on. Topics discussed in this episode, further details on KBRA's ESG approach, and other ESG-related media items. You can also join our mailing list to access our ESG Weekly Roundup newsletter.